Accounting cycle. Adam wants to start a business. Here's what Adam needs to know to manage the business well. What is accounting cycle? Accounting cycle is a series of steps in recording economic events affecting the financial affairs of a firm. Steps. 1. Identify economic events affecting the financial affairs of a firm. 2. Analyze, using accounting equation. 3. Record, from journal entry to financial statements. I think I'm ready. Hello, brother. I'd like to start a business.
Okay. What's your operating cycle?
What is that?
It is the process and time needed to convert from cash to cash.
Okay, let me learn it. Call you back. Adam is wondering what is operating cycle. He is also curious about how it is done. So he decided to read books and learn. Operating cycle is the process and time needed for cash to turn back to cash. It means you use cash to generate cash. In the operating cycle, you use cash to purchase inventory, then you sell the inventory and the customer will pay either cash or accounts receivable. If accounts receivable, then you will collect, and finally it will turn back into cash. After reading, Adam is meditating on what he just read. Operating cycle. Single step. Multi-step. Service. Merchandise. What if service? What if merchandise? Adam was a bit confused. So he read the book again before going to bed. When he wakes up, he decided to summarize everything he learned. Adam understood the meaning, internalized the process, so he made a comparison of the two as well as steps to understand the concept. Accounting cycle versus operating cycle. In the accounting cycle, you identify transaction events, then you analyze using an accounting equation and record the transaction by making a journal entry. In the operating cycle, you use cash to operate and generate cash. The conversion is either by service or selling merchandise inventory repeatedly. That's why it is called the operating cycle. Another illustration so you can understand the accounting cycle better. In the accounting cycle, you identify then analyze using an accounting equation, which is asset equals liability plus equity. You also familiarize yourself with the chart of accounts as well as rules of debit and credit so you can distinguish the effect of each account and their normal balances. The accounting standards are the principles or standards we follow in recording and preparing financial statements. These are the basis of how we arrive at a certain amount or journal entry. What are the possible scenarios in the accounting equation? Check this out. Accounting equation. Asset equals liability plus equity. 1. An increase in asset equals an increase in liability plus no effect for equity. 2. An increase in asset equals no effect in liability plus an increase in equity. 3. No effect in asset equals an increase in liability plus a decrease in equity, or vice versa. No effect in asset equals an increase in equity plus a decrease in liability. 4. An increase in asset and a decrease in asset equals no effect in liability and no effect in equity. 5. A decrease in asset equals a decrease in liability plus no effect for equity. 6. A decrease in asset equals no effect in liability plus a decrease in equity. 7. No effect in asset equals a decrease in liability plus an increase in equity, or vice versa. No effect in asset equals a decrease in equity plus an increase in liability. 8. A decrease in asset and an increase in asset equals no effect in liability and no effect in equity. Chart of account is a list of all the account names used by a firm. For example, account names, service industry, merchandise industry, cash, cash in bank, accounts receivable, accounts payable, service revenue, sales revenue, operating expense, cost of goods sold, selling expense, administrative expense, rule of debit and credit, asset account, liability account, equity account, income account, expense account, debit side, credit side, increase, decrease. Accounting standards are the generally accepted accounting standards or GAAP. Example 1. Revenue recognition principle. Means record income when it is earned. 2. Matching principle. Means match expenses incurred to its related income. 3. Consistency principle. Means consistency of methods and model used. And so on. Last step in accounting cycle is the record. Record consists of journal entry up to preparation of financial statements. Done with the accounting cycle. Let's go to operating cycle.